There is a silent crisis unfolding right now inside the French banking system. And the most dangerous part is not what the markets show, but what the institutions refuse to say out loud. French banks are on the edge of the abyss. European banks are interconnected in a web of debt so complex that a single failure could trigger a catastrophic domino effect. And yet, nobody is talking about it. Mainstream media is silent. Politicians are downplaying it. Central bankers are reassuring everyone. But behind closed doors, panic is rising. Hello everyone. I am a banking analyst specializing in systemic risk for the past 20 years. And I worked in 3 major European banks during the 2008 crisis. What I'm seeing today in the French banking system terrifies me because these are exactly the same warning signs as 2008, but worse, much worse. Because this time, central banks have already used all their ammunition. Interest rates have already been at 0%. Monetary creation has already been massive. There are no options left. In this video, you will discover why the French banking system is silently cracking. You will understand how European banks are interconnected in a house of cards that can collapse at any moment. And most importantly, you will learn the 5 precise warning signals that indicate a major banking crisis is imminent and why all 5 signals are present today. Stay until the end because I will reveal exactly how to protect your money before banks close their doors. Let us start by establishing a fundamental fact that most people do not understand. Modern banks do not function the way you think. They do not keep your money in a vault. They play with it in the markets. When you deposit $10,000 in a bank, the bank might keep $1,000 and lend out the other $9,000. This is the fractional reserve system. It is built on trust. Trust that everyone will not come to withdraw their money at the same time. Because if everyone comes at once, the bank does not have the money. It must sell its assets urgently. But selling urgently means selling at a loss, and selling at a loss means insolvency, and insolvency means bankruptcy. This is exactly what happened with Silicon Valley Bank in 2023. It was a bank run. Now, let us apply this logic to the French banking system. France has 4 major systemic banks: BNP Paribas, Crédit Agricole, Société Générale, and BPCE. If just one of these banks falls, the entire French economy could collapse. And through European interconnection, all of Europe could plunge. These banks are massively exposed to French sovereign debt. They hold hundreds of billions in French bonds on their balance sheets. Why? Because until recently, French debt was considered risk-free. Banking regulators did not even require capital to cover this exposure. It was the perfect asset, safe and profitable. But something has changed. French debt is no longer considered completely safe. France now has public debt of 3.2 trillion euros. That is 112% of GDP. The budget deficit is 6%. Credit rating agencies have started downgrading France. Fitch downgraded the rating. Moody's issued a negative warning. Standard and Poor's is watching closely. When a country's rating drops, that country's bonds lose value. And who holds these bonds? French banks. They are sitting on hundreds of billions in assets whose value is declining. Their balance sheets are deteriorating. Their capital is eroding, but they cannot sell these bonds. Why? because selling massively would make prices collapse even more. It would trigger panic. It would reveal the losses. So they are stuck holding toxic assets, hoping the situation improves. First warning signal: growing pressure on funding. Banks must constantly refinance themselves. They borrow short-term to lend long-term. That's the classic banking business model. But when confidence drops, funding costs increase. Other banks become nervous. They demand higher rates, or worse, refuse to lend. Interbank rates have increased significantly since 2023. The cost to insure French bank debt has soared. Credit default swaps, the insurance against default, have seen their prices explode. The market is saying something. It is saying that French banking risk is rising. BNP Paribas has seen its credit default swap spread go from 30 basis points to over 80 basis points in 2 years. Société Générale is even worse, exceeding 120 basis points. For context, in 2008, just before the crisis, spreads were similar. Then they exploded to over 300 basis points when Lehman Brothers fell. We are in the escalation phase, not yet in total panic, but clearly in the danger zone. Second warning signal: fragile balance sheets and risky assets. French banks are not just exposed to French debt, they are exposed to all of Europe, including Italian, Spanish, and Portuguese sovereign debt. They hold loans to so-called zombie companies that survive only because of low interest rates. They hold real estate loans in a market that is starting to crack. They have exposure to complex derivative products that are essentially ticking time bombs. BNP Paribas has over 2 trillion euros in assets. But how much are those assets really worth? Are they valued honestly? Or are they inflated with optimistic accounting models? That is the big question, because banks always tend to overestimate their assets and underestimate their risks until it is too late. Look at the capital ratios of French banks, around 13 to 14%, according to Basel III standards. Sounds solid, right? But here is the trick. Who decides the risk weightings? The banks themselves. They say they are solid. Regulators accept it. And everyone pretends it is true. Third warning signal: political paralysis. France has been in a political deadlock since 2024. The government is weak. Parliament is fragmented. Necessary reforms are impossible to pass. The budget cannot be voted on. Deficits are exploding. And meanwhile, problems are accumulating. To stabilize the banking system, banks would need to be recapitalized, injected with fresh capital. But where would this money come from? From the government? The government itself is indebted at 112% of gross domestic product. It cannot save the banks without going even deeper into debt. From private investors. Why would they invest in fragile banks with questionable balance sheets? From the European Union. The European Union has its own problems. Germany is entering recession. Italy is still heavily indebted. Spain has high unemployment. Who is going to save whom? This is the paradox of the European crisis. All countries are interconnected. All are fragile. No one has the resources to save the others. Fourth warning signal: growing fear inside the banking sector. Inside the banks, employees know. Traders know. Risk analysts know. They see the real numbers. They see the exposures. They see the fragility. And many are starting to panic discreetly. I have contacts in several French banks. They say the directives are to minimize risks publicly, and some people are starting to look for jobs elsewhere. These anecdotal signs are important. They are the canaries in the coal mine. Look also at capital movements. Official numbers still show stability, but those numbers are always lagging. When they reveal massive leaks, it will be too late. Fifth warning signal: institutional silence. This is the most revealing. Authorities are silent. The Bank of France is downplaying the situation. The ECB is reassuring the public. Finance ministers say everything is fine, but this silence is not reassuring. It is terrifying. Because if everything was really fine, they would not need to say it constantly. The silence is a strategy, not because the problem is small, but because openly acknowledging the problem would trigger the crisis everyone is trying to delay. This is the central paradox of modern banking crisis. Confidence is everything. If authorities admit there is a problem, confidence collapses. Depositors panic, investors sell, and the crisis becomes self-fulfilling. So they stay silent, they downplay, they buy time. They hope something changes, that markets calm down, that growth returns, that problems resolve themselves. But history shows this never works. Structural problems do not disappear with time. They worsen. If you are starting to realize that your money in a French bank may not be as safe as you thought, if you understand that we may be just a few weeks or months away from a major banking crisis, then subscribe to this channel now and activate notifications, because when this crisis explodes, you will need to act quickly. Now let us understand why this situation is so dangerous. Modern banking systems rest on perception as much as capital. A bank's real strength matters less than the perception of its strength. As long as people believe a bank is solid, it is. As soon as they doubt, it collapses. It is collective psychology. It is a self-fulfilling prophecy. And the French situation is uniquely dangerous for 3 reasons. First reason: size. French banks are enormous. They are interconnected with the entire European and global system. A French fall would not stay French. It would contaminate everything. Second reason: debt levels. France is over-indebted. Its government, its companies, its households. When everyone is indebted, everyone is vulnerable. One shock triggers cascades of defaults. Third reason: political constraints. France cannot act unilaterally. It is trapped in the euro. It cannot devalue its currency. It cannot print euros alone. It depends on the ECB, and the ECB must manage 20 different countries with contradictory interests. Decision-making paralysis is likely. When banks are trapped holding assets, they cannot sell without causing panic. Stability becomes conditional. It depends on confidence continuing to hold, and confidence is fragile. It can break in a few hours. Look at Silicon Valley Bank in 2023. Wednesday morning, everything was fine. Wednesday afternoon, a rumor on Twitter. Thursday, a bank run begins. Friday morning, the bank is bankrupt. 48 hours. That is all it takes in the modern connected world to destroy a bank. Now, imagine the same dynamic with BNP Paribas or Societe Generale. These banks have millions of clients and hundreds of billions in deposits. If a run starts, the entire European banking system would be threatened. Other banks would panic. Interbank lending would freeze. Markets would collapse. Governments would have to intervene. But with what? They are already indebted to the maximum. This is not just a French problem. European banks are interconnected through debt, derivatives, and funding markets. Stress in one major economy forces a re-evaluation everywhere else. Once investors start questioning which balance sheets are really safe, contagion becomes inevitable. Italy has fragile banks. Germany has Deutsche Bank, which has flirted with bankruptcy several times. Spain still has real estate problems. Each country has its own weaknesses, but all are linked. A crisis in France spreads immediately. And here is why these crises rarely arrive with clear warnings. They form silently behind reassuring language, controlled narratives, and delayed reforms. By the time public conversation changes, positioning has already changed, and options have narrowed. Insiders always act before the public. Hedge funds sell. Traders buy protection. The ultra-rich move their money out of at-risk banks. Then, weeks or months later, the crisis becomes public. The media talks about it. Politicians react. But it is too late. Losses are already locked in. This is not a prediction of an exact collapse date. It is a structural analysis of risk, how banking crises really form, why silence plays such a critical role, and what happens when political reality collides with financial mathematics. The mathematics are clear. French debt is unsustainable. French banks are overexposed. Capital ratios are illusory. The system is fragile. But politics says nothing can be done. Raising taxes is impossible. Reducing spending is impossible. Recapitalizing banks is impossible. So we continue. We pretend. We hope. Until markets decide it is over. And when markets decide, it is brutal. Rates explode. Bonds collapse. Bank stocks plunge. Panic sets in. And in a few days, everything changes. Now, what should you do concretely to protect your money? Here are 5 immediate actions. Action number 1. Diversify your bank deposits. Never keep all your money in a single bank. Diversify by spreading deposits across several banks, and when possible, across different countries. If one bank fails, you will not lose everything. Deposit insurance. In France, covers 100,000 euros per person, per bank. But this guarantee only works if a few banks fail. If the entire banking system collapses, these guarantees are worthless. There is not enough money for everyone. Action. Number 2. Keep physical cash. Yes, cash. Paper bills kept at home, in a safe. Not large amounts, but enough to survive a few weeks if banks close. In 2013, in Cyprus, banks were closed for 2 weeks. People could not withdraw money. Those who had cash survived. The others suffered. Action number 3. buy physical gold. Gold is the ultimate protection against a banking crisis. It does not depend on any bank, any government, any system. It has value everywhere, always. Even 5 or 10% of your wealth in physical gold can make the difference between surviving and losing everything. Action number 4. Move part of your assets out of Europe. Open an account in a Swiss bank, a Singaporean bank, or an American bank. The world's best banks are not in Europe. If Europe collapses, you have a lifeline elsewhere. Action number 5. Prepare mentally. A banking crisis is chaotic. It is terrifying. People panic. The media amplifies fear. Government lies. You must keep your calm. You must think clearly. You must act rationally when everyone around you is losing their heads. Here is the final truth. The French banking system is in a precarious position. All warning signals are present. Confidence is eroding. Options are narrowing. And when markets depend on confidence to survive, the moment when confidence breaks is never gentle. It is violent. It is sudden. It is devastating. Will it happen next week? Probably not. Next month? Maybe not. But in the next 6 months, in the next year, probabilities increase every day. Because structural problems are worsening, debt is increasing, deficits persist, politics is paralyzed, and confidence is eroding slowly but surely. If this analysis of the silent French banking crisis has opened your eyes, if you now understand that your money is not as safe as you thought, then subscribe to this channel immediately. Activate all notifications. Share this video with your family and friends. They need to know. Their financial future depends on it. In my next video, I am going to reveal the 3 precise scenarios of how this crisis could unfold, what the likely trigger will be, and how governments will react to try to contain the chaos. Leave me a comment if you have already started protecting your assets. Have you diversified your banks? Have you bought gold? I read all your comments. Thank you for joining me in this exploration of a crisis forming right now before our eyes. Remember, banking crises are never announced. They form in silence, explode in chaos, and destroy with violence. Your only protection is preparation. Act now, while there is still time. You know now. Do not be a victim.